Everyone, it's Alex here at Testing Capital Research. Welcome to our Inner Circle webinar. It's Tuesday the 26th of September, currently just after 5 o'clock Eastern for the benefit of the tape. Okay, so today I want to cover two topics specifically. Let's look at the equity indices. Obviously taken a bit of a battering in the last few days, so let's look at where we stand on those. And then I want to go on and look at sector ETF rotation, which a number of people have asked for us to cover in the service, and we do it elsewhere. So starting from this week, but dripping, a sort of drip to drip beginning, we'll do that here in a circle, and we hope to do it well too. So I want to talk about that a little bit, what the strategy is, how to do it, and what to expect in the service. And as always, with these sessions, any questions, comments, points, anything at all, please do shout. Either use the audio settings of the webinar platform and shout into the system, or failing that, use the Inner Circle Slack chat room. I can see questions in there and read them out for the benefit of the group. Okay, before any of that, let's just do our disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, index review. Right, so if you've been looking at our charts that we post in the Market on Open note every day, you'll know that there's nothing to see here really. It's a standard retrace within an overall up move, and nothing that I've seen would dissuade me of that at this stage, and that can change tomorrow. But just let's take a step back and look at how things stand. So I am not sure whether in the long term there is a direct linkage between the price of money as measured by the yield on the 10-year Treasury note or risk-free rate, or whatever you want to call it, and equity levels. And the reason I'd say that is if you zoom out far enough, you can see that equities trend up over time, unceasingly, and the yield varies a lot. It's had decades of moving down, periods of moving up, and I think that in the very short term, for sure, changes in the yield can lead to changes in equity levels. I think in the time frame that we're currently in, I suspect that as the yield reaches what looks to be a wave 5 termination level, it seems like the yield can be charted and analyzed technically like anything else. I suspect we'll see the yield roll over, and I suspect we'll see equities move up. Equities look like they're trying to find a local low. Short positions or shorts taken out of this level look risky to me. There is a loud chorus of bearishness all over social media and the TV, and that usually coincides with the time that you should be cutting shorts and adding longs, not the time that you should be opening shorts. That could be wrong, obviously, but that's how it appears to me. Very uncomfortable, obviously, to be long at this point, particularly if you use the levered instruments, as I do. But as you've seen me say many times in the service, personally, I don't fear stranded longs, at least not in the indices. The indices always trend up over time. What scares me is stranded shorts. And so if you look at the trade disclosures, I think it's fair to say that personally I exited my shorts early. That's okay. Exited them all at smaller or larger profits. That's okay. And I'm personally sat waiting for the market to turn up. And again, if anything changes, if we see a fundamental change in the market, then we can always open new short positions, either hedge 1-to-1 just to hold the line, or go net short to ride the market down. So the beauty of the index trading method we use is, you never have to take a religious position. If wrong, just open a position that's pointing in the other direction in some proportion to your current direction. So if you are long at the moment, you're worried, then open a small short or a fully hedged short, or even an overhead short. My own personal view is we're searching for a local bottom at the moment. I think the market's going to reverse up, and so I'm happy with a purely long position in those triple levered ETFs. But if that changes tomorrow, I can change my view. That's the whole beauty of the strategy. If you step back and you look at, well, what are the arguments for a move up? I think there's many of them. So that you have many technical arguments, be it the yield chart, which I'll put on the screen in a moment, or individual equity index charts, that they all look like the yield's about to roll over and move down, and the indices look like they're about to find support and move up. Bonds, if you look at the TLT ETF, it's at exceptionally low levels, and it's also at levels that have formed a bottom over multi-years. I'll show that in a moment. And if you look at the macro environment, why would equities keep moving down? GDP growth is strong, jobs market is good, consumer balance sheet is good, company earnings are good. I saw a comment recently to the effect that earnings multiples on I think the Hang Seng and the DAX are exceptionally low right now. And that will, I'm sure, prove to be the case in the S&P and the NASDAQ when Q3 starts to get reported on. So all macro indicators I can see also look like should be finding a local low soon. If you step back and say, well, what are the arguments for continued sell-off? Obviously, you always have momentum. Momentum is a great argument, no doubt. But aside from momentum, what are the arguments? We're in a declining inflation environment. It's unlikely, in my opinion, the Fed's going to hike anymore. I know about the dot plot, but I think what the ECB said today was very clear, which is no new hikes. Well, inflation's much higher in Europe than it is in the US. It's not come down nearly as quickly, and it's at a much higher absolute level. But you have the ECB saying no new hikes, and it's not an accident that the Fed, the ECB, the Bank of England, and others all tend to move in lockstep. So I think the ECB was running up a trial balloon for what the Fed failed to say last week, which is no new hikes. So I think you have a number of technical and fundamental arguments for the indices to find local support right now. I can only think of one bearish argument, which is momentum, and that isn't to say that's not a strong argument. It is a strong argument, but it's the only one I can think of. And so to me, it looks like we're going to find support and move up. But again, the beauty of the index strategy that we use in this service is, if that proves wrong or you're feeling uncomfortable, you always just open a hedge to protect the line or indeed to try to profit from any further move down. Let's just look at a few of these charts. Let's look at the yield. Let's look at TLT. And then let's look at the indices themselves. I'm just going to switch the screen here. Okay, so why don't we start with a 10-year yield? Now, unsurprisingly, I suppose, you can apply technical analysis to the yield. If you think that there's nothing really fundamental about this risk-free rate, the yield on the 10-year note, it's just a trading instrument like any other. And so then it trades to quite well to Fibonacci levels, and Elliott wave shouldn't be a surprise, I guess. This chart runs, you see this every day. This runs from the COVID lows. We get a wave one up. Remember, if the yield is up, that means that bond prices are down. If the yield moves down, it means bond prices move up. And in general, you want bonds moving up for equities to move up. If you can think of the whole thing as a risk asset class, so bonds up, equities up usually. So here we have, here's the COVID lows, a wave one up that moved really quickly from early March to mid-March, and the wave two down into August 2020, not coincidentally, a 78.6 retrace, a wave 3 up in the yield. Now, yield up means bond prices down, and that coincides with basically equities moving up for the most part. And this peaks in June 22. We get a wave 4 down into August 22, and then what looks like a wave 5 high here, which was the equity market lows. So yield's very high here. That means bond price is low, equity price is low. And then that's October last year. And as the equity market starts to rise, you see this beginning of a trend down. Just put a channel here. You see the beginning of this trend down like that from October down to July this year. And so the yield falling, that means bond prices are rising, and equities rose strongly, as you know, from October last year to July this year. And then, actually, that's just the beginning of July. So it would be easy to conclude that that was a wave 5 high right there, and we were going to move down into a low down here and then a move back up again, something like that. The Fed's language has been that, this higher for longer language. I think the Fed is trying to engineer not just a soft landing in the economy, but also to not flip a switch where risk asset prices suddenly go insane, which, if the Fed was to say, we're done hiking, we're going to start cutting rates, then you can imagine what would happen to equities and bonds overnight. And so I think the Fed's been very cautious on that front, and that's, I think that language has been exploited by markets to drag this yield up by way of pressure on bond prices. We are approaching, however, a range where you really would expect this wave 5 to terminate. So you've seen to say many times that wave 5s terminate between the 61.8 and the 78.6 extension of waves 1 to 3 combined. Sometimes they go higher than that, but a lot they do terminate here, and we're right in that zone now. If you just zoom in a bit, so this is in Asian trading right now, and you can see that Tuesday New York trading times or Chicago trading times, it was in essence a flat day. It moved around a lot in the day, but you see that flat candle on the day, so lots of movement, but in the end open and closing about the same place. Yields up a little bit in Asian hours right now. Actually, we were about to move into Asian hours, I'm sorry. So this looks like a topping pattern to me. Could be wrong, but that looks like a topping pattern. Let's look at TLT, which is the ETF that tracks, again, treasury bonds. So let's look at that. Let's just look at the absolute price level here. Forget the recent movements. Let's switch it on to the monthly. So bonds peaked February 2020. TLT, I should say, peaked 2020. And look at this. This is an ETF that tracks bond prices. Let's just look at this level here. So it was last at this level in 2011. And this level has acted as a support all the way back to 2007. So deep in the financial crisis, May 2009, here we go, TLT was at this level. So if anyone thinks that financial conditions now are the same as they were then, I'd like to hear them explain why, because they aren't. Now this says to me that we're due a big reversal in TLT, and with that means bond prices are moving up and yields moving down. So this is pretty good evidence, in my opinion, that we're about to see an equity reversal. It may not happen tomorrow, maybe it's next week, maybe it's later, but that the next direction of the next big move, I think, is up. Let's step through the indices. We'll do just briefly the longer term charts. The shorter term is more interesting really at the moment. So, you know, at this level of abstraction, whether you look at the S&P or the NASDAQ or the Dow or the Russell, you know, there's no change here from the longer term chart that we've been mapping out in the service for some time now. If you look at the Russell, which has been the weakest, you know, we're right back at this rising support line that's held true since October. So the Russell is coiling through this accumulation zone, in my opinion, and it's going to break up and out through this markup zone. And it's in this consolidating range here. Every time it's hit this red resistance line here, it's sold off all the way back down here. Hit it again in July here, sold all the way down to here. Little fake out there. So you see an A, B, C wave here. B waves are always very treacherous, make you think, it's end of August, make you think that everything's going to be okay. It's not, turns down, sells again. But best guess we find support around here in the Russell. And at some point, which is what I want to be positioned for, some point it's going to rip up and through the markup zone. Those of you who follow uranium are seeing at the moment what the markup zone looks like when it happens. Let's just have a quick look at those uranium charts right now as evidence of that. So to be clear, I'm not linking this to index performance. I'm saying this is why you want to be well positioned when a markup zone happens. So this is U.UN, which is the spot uranium. Sprott is the fund manager, and it's a spot uranium trust. This is what happens when markup happens. I mean, this is just late buyers piling in, and this fund has gone from $16 a share in the middle of July to $24 Canadian dollars a share now. So you have 50% rise in the space of 2 months. That's what the markup zone can look like. If you looked at URNM, which is the miners ETF, similar story. At the end of May, $28 a share, US dollars. Right now, $47 a share, so very nearly a double. And look at the ascent in this markup zone. And so back to the IWM. Why I want to make sure I'm well positioned for this is because once that starts to rip up there, if we look back at what happened in 2020, late 2020, there was no stopping it once it started to run into markup. And so I do want to catch that zone personally myself. Let's look at this shorter term charts. So let's do that by the futures as always. So these are just the charts that you see in the market on open note every day. Well, the important point here is look at the degree to which these things respect technicals. So from the October lows in the S&P, we get a 1, 2, 3, 4, 5 waves up for each, making up that wave 1 there. The wave 2 comes down to the 61.8 retrace, and then we're in the middle of this long wave 3 up now, which will run to, you know, probably the end of the year and beyond, I suspect. And we've been in from March to July, a wave 3 of 3. And so from March to July, it felt unstoppable. Anyone who had short positions through there that was just toxic. And what you see now is from 3 down to this probably a 4 low, is all you have is a 38.2 retrace, a bit lower of this wave 3 up. So far, no big deal. And as I said a number of times, even if we went down on the ES to 4,200, in other words, we retested that wave 1 high, that's still a bullish chart. That's just what you would expect from a wave 4 low. And in fact, if the wave 4 stops now, you'd say, well, that's not much of a retrace in truth. It feels big because this wave 3 was a big one. It was nearly a 200% wave 3. But a 38.2 retrace wave 4 is not a big deal. We're due a reversal when we find it. Again, I would expect that wave 5 to peak somewhere between the 61.8 and the 78.6 extension of wave 1 and 3 combined. What that means is a target price somewhere in this zone. So somewhere between 4,800, let's call it, and 5,025, something like that, which would be, as you know, an all-time high for the S&P. Probably then get a large degree wave 4 down here, and then a final wave 5 high. So, of course, the S&P could dump tomorrow. The time I would start to get concerned is if the ES drops below 4,200, which is if it really truly drops below this wave one high, then this chart's wrong and something else has happened. But until then, it's just a regular technical correction. Same story in the Nasdaq. This is the NQ futures. In essence, this is the move up since the January lows. So a wave one up into February, a wave two down into March, a 200% wave three extension into July. And look, all we are now is we're not even at the lows struck on the 18th of August. So all the stress now, we've been here before the 18th of August. So this wave four again, I don't think it will, but it could fall all the way to 13,000. This would still be a bullish chart because that will be retesting this wave one high. More likely, maybe we see it fall to a little bit further down to this 14,455 level before I move higher. The point is nothing unusual here. It's just a sell-off. We're in a sell-off in an environment where the only bearish argument I can muster is momentum. That's not to undermine that as an argument. It's a good argument, but it's the only one I can think of, whereas there are many bullish arguments. If we get our wave five back up here, if it reverses at the current level, then again, we would expect to see the NQ futures terminate somewhere in this zone, in this cycle, and then a sell-off and then another move higher. So this again would represent a new all-time high for the Nasdaq. Let's look at the Dow. Okay, so the Dow, it looks to me like, so we started this wave one up in early July, and we are basically back at that level. And so the Dow is just retesting these levels here. And so I imagine what we'll end up concluding, which is it's just slightly above that. So that's either an incredibly deep wave two, or we may say, well, that was all a one and a two, and we have to start again from here. I don't know yet. But for now, this is just a fake out, breakdown, but we are at the levels last struck at the middle of July. And no one in July was crying that the market was going to go to zero. At some point, I think at some point soon, if you look at the Dow in a larger degree, this looks primed to me to move up to be the first index to reach new all-time highs. First of all, it's not very far away. And secondly, if you look at the volume profile on this thing, which I follow closely, that's a lot of volume here. And you have to ask yourself, why would that be selling? Why would that be institutional selling? I for the life of me can't think of a reason. So this to me is prep for a move up. I wonder whether all of the pain and narrative going on at the moment is because, frankly, a lot of institutions did miss these October lows. They're not going to like that. And so they're going to want to take money off of any people who were bought down here and are panicking and running for the door in order to load up here to make the win if and when indices make a run for a new high. I don't know, it's purely speculation. But if you look at the Dow, it's just a one and a two. It's a really deep wave two, but for now it's a two. If it goes below that, okay, we have to reconsider. But for now, it's just a wave two. Russell. As I said in the note this morning, we'd had this high here as a wave three high. That's clearly not correct now. That's a wave five, so that's a complete cycle. And what we're in now is an A, B, C correction now. These can terminate often where the C leg is equal to the A leg. And in that case, that would be around 1750 or so on the RTY. So perhaps there's a bit further to go yet, I don't know. But again, the next big move here, I think, is up. This is a textbook ABC correction. And the next move, I'm sure, here will be up. And so, in summary, no one knows what's going to happen with markets. It could drop again tomorrow. But we're not in 2022 now. We're not in a world where rates are getting hiked and inflation's climbing and all those things. The Fed has said almost certainly they're done. Anyone sensible suspects they're done. The ECB, the European Central Bank, told you that the ECB is done, despite inflation being higher in Europe than in the US. Bank of England is desperate, I think, to not hike rates further. This month they kept rates flat, but they increased QT, which of course is the same thing, but just plays better. So I suspect the Fed is done. And if the Fed is done, and if GDP continues to hold up as strongly as it has, if corporate earnings keep growing as they have, then risk-free rate coming down, risk premium ought to drive an increase in risk asset prices, but that's bonds and equities. So that's our house take on indices. Could be completely wrong, of course, but that's our reasoned house take. And again, if you're trading the index ETFs in the manner we suggest in the service, you can get it wrong a lot. And as long as you are within your guardrails, not over levered, not holding positions that are too big, you can use shorts or longs as you see fit, and you can always live to fight another day. So if you think the index is going to drop to the floor tomorrow, you can always add a short position. If that short position makes money, that's great. If it doesn't, starts to lose money, you can quit out of it with a small loss. You always have the option to course correct, which is what makes it such a great strategy, we think. Okay, I want to talk about sector ETF rotation, but before we do, if there's any questions at all, now would be a great time to do it. So again, as always, either open your mic and shout into the system, or you can use the Slack chat room and post any questions in there. So I'll just check whether anyone's done that. Okay, no questions in Slack. Let's see if there's any questions here. Okay, we have nothing here. Everyone's asleep. Excellent. Okay, so let's take a look at sector rotation using the ETFs. I'm just going to switch screen once more. Okay. Righto, sector rotation. Now, the idea here is to use, as you know, we use Wyckoff rotation theory in both the indices, but particularly in single stocks. And so with our single stock coverage, the reason we use those accumulation zones, markup zones, distribution, markdown, the whole idea is to try to beat buy and hold in any one particular stock. And the whole idea is, well, if you're going to beat just buying the S&P and dollar cost averaging into it, which is a perfectly fine way to manage money, if you're going to beat that, you have to do something special. And so you can hope to find tomorrow's hot stock and buy startups and all those things, but in our opinion, a more reliable way to do it is to follow big money around. And what big money does, because it can't buy stocks quietly without moving the price, it on purpose behaves in a way that moves the price. And so sector rotation theory and Wyckoff rotation theory in general, what we're trying to do is find those accumulation zones where large accounts are building up positions in a stock or an ETF in order to then set free the narrative, the bullish narrative, whereupon late money comes in and fuels that markup zone, which leads then to profit taking by those large accounts in that distribution zone, whilst the narrative is still positive. And so remember, if you're going to follow this, you have to trust your analysis. You have to follow the charts. And even though at the time you're selling, everyone will be screaming that the thing you're selling is going to the moon, that's the whole point. During markup, but particularly during distribution, you'll see an overwhelmingly positive narrative, and during accumulation, you'll see an overwhelmingly negative narrative. So the whole point here is wear a lead helmet, right? Ignore anything you see on financial media, television, even the Wall Street Journal to a degree. Focus on price action. Price action, in particular volume, will tell you what's actually happening. Sector rotation we see as an opportunity to use Wyckoff rotation at a lower level than just the indices, but a higher level of abstraction than single stock names. So again, it's an opportunity to try to beat simple S&P 500 buy and hold, because again, as Buffett will tell you, S&P 500 buy and hold, 7% return on average per year over a very long period of time. That's pretty good. And so if you're going to try to beat that, you have to be sharp. The reason to use ETFs is very simple, which is it's less risk. So you take away the possibility of a big earnings surprise happening to a stock you're trying to do this rotation with, or maybe it's acquired at a price that you were hoping it would exceed. Maybe the stock hits regulatory problem. Who knows? There are 101 things. But so ETFs allow you to abstract somewhat from single stock names, and it therefore, in our opinion, is a lower risk strategy than just single stock rotation. It's probably higher risk than index rotation, but done well, you can probably achieve higher returns. And again, we think this is a strategy that we can be used for regardless of your occupation. As a member of the service, we have fund managers, registered investment advisors, independent investors here. This strategy can work for all those different investment methods. Okay, so we're going to use the SPDR family for no particular reason other than they're liquid, popular, well-known, and they trade really well to technicals as a result. We use 11 of them. I think I caught them all here. So XLE Energy, XLF Financials, Com Services, and so on. And the idea is to try and capture all the major sectors of the US economy. And the idea with that is to try to have basically a perpetual rotation machine. So when some are up, others are down. When you're distributing one, you can be accumulating another. The whole thing is supposed to be basically a perpetual money machine if you do it right. XLK in here is tech. It's broadly comparable to the QQQ. It doesn't move quite the same. It's got a bit more legacy tech in there. So we'll include that. You don't have to use XLK. You could use QQQ if you wanted to. We treat this as separate. QQQ we use as part of our index strategy with the TQQQ long and SQQQ short, or QQQ long and I think PSQ short for the unlevered. So XLK is the SPDR tech fund. And this is a key point. Technical analysis only. We make no attempt to provide fundamental analysis of any of the underlying stocks within the ETF. We don't look at the management fee levied by the ETF, or anything to do discount or premium to NAV, anything like that. This is purely technical analysis. All we are trying to catch is the ebbs and flows of the price in these ETFs. And the reason to do this is, done right, we will always have some things that are in markup, some things that are in distribution that we can be selling, some things in markdown where we're doing nothing. So maybe you want to short them, but we'd be doing nothing. And some things in accumulation where we'd be buying. A perpetual money machine. That's the idea. Okay, let's take a very quick look at some of these sector ETFs, and then we can stop for questions. I'm going to switch screen again. It's just 1 second. Okay, so let's start with XLK. Why not? XLK, unlike the NASDAQ, already made a new all-time high. It was struck in the middle of July. And it trades really nicely to technicals. And so we have, going back to the 2018 low, wave 1 up, 2 down, 3 up, big wave 3, not quite as big as the NASDAQ, but bigger than the S&P. A wave 4 down, which you'll see didn't quite trouble the wave 1 high here. That wave 4 low was struck in October 22. And then we're in the middle of a wave 5 up here. Now, all the same things I've said about the NASDAQ, which is it's possible this is a wave 3, not a 5. That all applies to XLK as well. But base case, that's a wave 5 up. And if that's a wave 5 up, then we ought to be seeing a potential for distribution up here. Now, if we're in a wave, that's why this is important to work out correctly, is because if this is a wave 3 and you distribute here, you're going to miss out on a lot of money. And so I've said many times that one of our next jobs in the NASDAQ here, if indeed the NASDAQ turns up as we think it will, one of our next jobs here is to work out, okay, are we pushing up in a wave 3 or a 5 here? And we'll hope to not get that wrong. But that's XLK. So on a conventional base case analysis, tech has led the way all through 2023. So no surprise, we're in the markup zone now, and we should be heading for distribution if indeed this is a wave 5 up. Let's look at financials, XLF. So this is a longer term chart than XLF. XLF put in a wave 5 high already, and it did that at the end of 2021 on this chart here. So from the 2009 lows, financial crisis lows, we had a wave 1 up, 2 down, and amazingly, quite remarkably, obviously XLF mooned in 2007 when we had free money and so forth, pre-mortgage crisis. And look, the high it struck in January 2020, just before the COVID crisis, was exactly the high struck in 2007. Remarkable. We get a wave 4 down into the COVID lows, and then this wave 5 high here. And then we've since dropped back. We had March, there you go, February, March, banking crisis in the US, and the stock is, the fund is probably in an accumulation mode right now, pending a new wave 1 up. So XLF is one that we think is in accumulation at the moment. We'll post all these in more detail over the coming days and weeks in the service, but XLF we think is probably right for accumulation, not least because if in fact rates do start to fall, we also see some benefit in the financials. So XLI is also already made an all-time high, and it's made significant all-time highs this year. You can see that it's, again, trends to technicals really well. We'll do our usual Wyckoff analysis for you, the service, in the coming days and weeks. But you can see that this thing trades, perfectly to technicals. This has been in an uptrend since, you could argue February 2003, and most certainly from the financial crisis lows, where this has been basically an only up fund with a brief spike down correction in COVID, but a very rapid recovery out of it. Let's look at XLC. This is comm services. This includes things like Facebook and others. This is in markup right now, we think. So this is, we're modeling this from the COVID lows with a wave 1 up into 2021 highs in August, a wave 2 down, quite a deep one, bit more than 78.6 retrace down into October. This is when Facebook and things, Facebook was trading at 7.5 times cash flow at this point, very viable, as we said at the time. Passed through the accumulation zone here, and now we're in markup, but quite a way to go probably before we even think about distribution. I mean, in truth, if we were being a bit more bullish here, well, really and truly, you would expect that wave 3 to run up to the 1.618 extension. So there may be a long way to go yet in XLC. We'll see. Energy, XLE. This level in XLE of 93, 94, 95 is really crucial. So it looks to me like it's probably trying to push through in a wave 5 up, but perhaps this is all we get and it rolls over. So again, obviously energy performed incredibly well through 2022. It was the thing to be in 2022. From the lows of the year at 65, it peaked at 95. Not much went up by 50% in 2022, but energy did. And so the question is, can it push up through here, or is it going to roll over and sell off? So XLE is probably one to be careful of going long at the moment, I would have thought. We'll do one more. Real estate, XLRE. This is technically fallen into our stop zone with the climbing of that 10-year yield, but I don't hold XLRE myself at the moment, but if I did, I probably wouldn't have stopped out at this point. I would probably still be holding it in anticipation of a move up as rates start to fall. To state the obvious, rates down, money cheaper, beneficial to real estate stocks. So what you'll see in the service, I'm just going to switch back to our presentation right here. What to expect. So we don't have it yet, but on the Inner Circle website, you'll soon see a sector rotation page that will explain strategy and method. So you see that already for index trading, for portfolio rotation ideas, and you'll see that for sector rotation as well. We'll add the 11 ETFs I've talked about to the stock spreadsheet. That will include ratings, chart links, and comments on any staff personal account positioning in those names here at Cestrian. One thing we need to do in the Slack system is start posting when we do ratings changes. So we'll start doing that for all covered stocks, and we'll certainly do it for those for the ETFs that we talked about. And for clarity, we're not going to run this rotation as a model portfolio. This is a self-service strategy. So whether you're an RIA or a fund manager or an independent investor, this is obviously work for you to use in your own work. We think it's good work. We think it can work for you. But what we'll do is we'll flag as and when these ETFs change rating. So we'll say, it's moved from accumulate to markup, move to hold, hold to distribution zone, move to distribute, and so on and so forth. So look for those. We'll put a new channel probably in Slack called ratings changes, something like that. So look for that. We'll add everyone to it, and then we'll include the ETF ratings in that channel. So we'll get that developed over the course of the next few days, next couple of weeks, and you should start seeing that. I think the strategy can work really well. And again, ETFs means it can be used by many different types of investors. And if you're an RIA and you want to use this, then it should be a straightforward thing to explain to your clients. Well, I'm buying XLF now, because, or I'm selling XLK now because. So it shouldn't require too much in the way of having to get into the weeds on any single stock decision. It should be able to be fairly simply explainable, and to the extent we can, we'll provide logic as to why any particular sector is, we think, under accumulation or markup or distribution. And again, if you're an RIA or a fund manager, you can use that in the commentary to your clients. We'll only provide the basics. Your clients, we don't, but we can give you some bullets and talking points at least. Okay, that's all I hope to cover today. So again, any questions, comments at all, shout into audio or post in the Slack chat room. Let's just check Slack right now. Okay, we have no questions here. I don't think we have any questions in the room here. Yeah, no, I'm sorry, I don't have questions. Okay, so 2 questions. Okay, question 1. How much of portfolio do we recommend holding in the sector ETFs versus the 3 times leverage? We don't, right? That's something that you have to work out. That is entirely a personal matter or a client matter, and it's beyond our ken to talk about. So that's just something you have to work out. The triple levered ETFs are high risk if they're unhedged. Obviously, if you hedge them correctly, they're not as high risk. Sector ETFs, there's less day-to-day volatility in because they're unlevered. On the other hand, the upside isn't as big probably. So that's a question that you have to work out. We know that XLE is in a distribution zone, but from the market on open, you indicated long on TQQQ. Okay, so to be clear, personally, and of course, each to their own, everyone will do things differently. But for me, the triple levered index ETFs are a strategy by themselves. So if I were running, money on the basis of this service, I would probably have a pool of capital that ran the index strategy and that dealt solely with the triple levered index ETFs, long and short. And I would have a pool of capital that handled the sector ETF rotation strategy, and I wouldn't mix the two. That's probably how I would do it. And so I would never think about holding TQQQ versus selling XLE. They're different things. So if I'm running the sector rotation strategy, in my mind is, should I be selling XLK now because it's already put in an all-time high? I wonder if that's peaked. On the other hand, well, the Nasdaq might be in a wave 3 up, and if Nasdaq's in a larger degree wave 3 up, then XLK is going to go with it. And if I sell XLK now, I'm going to miss out on a lot of upside. That would be my head scratcher on XLK. And on XLE, I'd be looking at probable declines in the oil price and the fact that it can't break a quadruple high, and I'll be thinking about, is that it for XLE? The argument that XLE is going to fall rather than XLK is going to fall, I think is stronger. And I would be thinking about XLF and thinking, should I be accumulating that, and if so, to what? So in my mind, and in this service, the triple levered index ETFs are a bucket of money over here, and the unlevered sector ETFs are a bucket of money over here, and they're the twain shall meet. So that's how I think about it. Now, you, of course, will think about it differently, and you'll do what's right for you. But that's how I think about it anyway. I hope that helps. Okay. All right. No worries. Okay. Any other questions, folks, before we finish up for the day? Just check chat here. Okay. In that case, let's finish up. We'll post a recording in a couple of hours once it's compiled. You'll start to see this sector ETF stuff come through on the website. And as always, it remains for me to thank everyone for being a member here. Service continues to grow like a weed. That's just fantastic. And hopefully you will find it useful, enjoying it. If, by the way, you have anything really nice to say about the service, let me know. I'd love to put it in testimonial on the website. If you're unhappy, frustrated in any way, then reach out, email me, or use the contact form on the website. And anybody unhappy, we always look to find a way to improve the service or be clear about what we're doing. We don't want any frustrated, silently unhappy subscribers. Reach out and tell us. Equally, if you're happy, tell us, because if we can use your testimonials to help ourselves grow, that's just great. So again, thanks everyone, and look forward to speaking to you all in the chat in Slack later on, and I'll post the video in a couple of hours again. Thanks a lot, folks. Speak to you all soon.